Hello. Is the slide visible?
Yes, sir, we can hear you, plus we can see you.
Okay.
As a patient, first I'll have to calculate CAGRs and then I'll be able to.
Yes. Yes, sir. So welcome, dear delegates, for this Financial Intelligence for Pediatricians series. This is the 3.0 series because we have started 2 years back. Every year we are doing it as a series. With that brief introduction, I would like to call upon Dr. Harish Gopal sir to give brief introduction about the topic today and also the speaker. And we'll start the session. We are from Indian Academy of Pediatrics, IAP Telangana State, and also Indian Academy of Pediatric Twin Cities branch. When I was secretary of Pediatric Academy of Telangana State, we have started this Friday Financial Fitness Certificate course for 8 weeks, which was well taken by all the pediatricians across the country. Now we are into 2 WhatsApp groups with more than 1,800 pediatricians joining this forum, and they are learning the financial basics. They are increasing their financial literacy and the return on intelligence, ROI, that it's not return on investment, but it is return on intelligence. What we have learned from the esteemed speakers, we are earning a lot and we are saving a lot of things. Today also we have one such great session by Dr. Balwant Jain sir, who is a featured writer, and he's a he participated many TV shows educating doctors, all the faculties across the country regarding the finances. So over to Harish Gopal sir.
Thank you, sir. This is a very important. This is a very important session. Very important session because as many of you know, that we can easily save taxes by forming an HUF, and also we can easily protect our assets by forming an HUF. So please listen from a tax expert, Mr. Balwant Jain, so that all of you should start an HUF immediately. Over to you, sir.
Thank you, Dr. Pawan, Dr. Harish, and other office bearers. It's a pleasure to interact with such intellectual crowd. I welcome all other ladies and gentlemen in the audience viewers. So this HUF is a peculiar concept under the Income Tax Act, which helps people save tax. So first, let me tell you what we will cover. Initially, I will give you the brief about what is an HUF and who can create it, how it comes into existence. Then we will discuss about HUF and what is HUF and what is HUF property. Then very important and contemporary subject of the rights of daughters in the HUF property. Then the main feature of the talk for which all you have joined, what are the tax benefits which are available to an HUF. Then what is the action plan you need to take to bring an HUF into existence, and then some of my questions and answers, and then we will take viewers' questions. So I will attempt to make my talk as brief as it possible so that we can address the questions from the audience. What is an HUF? So for HUF is nothing but if elaborated, it is Hindu undivided family. So as the title itself suggests, that for having an HEF, you have to, there has to be a family. So there have to be minimum 2 persons to constitute a family. So the concept of HEF is derived from Hindu law, where there is a concept of a Hindu family, not Hindu undivided family. So Hindu undivided family or an HEF is a peculiar concept under income tax law. So who can have an HEF? So as the name suggests, it is Hindu undivided family. So all Hindu can have an HEF. And for the purpose of this concept of HEF, Hindu includes Hindu proper, then Jain, those people following the Jain religion, Buddhism or Sikhism. There are a few people or people following religion who are expressly excluded from having an HEF. Those are Parsis, those following Parsi Zoroastrian religion, Islam religion, those who are Jews and the Christian. These cannot have an HEF. So what is an HEF? Going further, HEF is a creation of law, unlike a partnership firm or a company which is created by an action of law. Partnership is created when you into existence of its own. You cannot create an HEF. HEF comes into existence when a co-partner is born in the family. I will explain what is a co-partner in due course. So all the persons who have descended from a common male ancestor up to the 4th generation are member of the HEF. Either the person may become a member of the HEF by taking birth in the family, or he can come into the family by adoption. Even the people who come into the family by virtue of marrying members of the family are also treated as a member. So for the purpose of an HEF, the person proper whose HEF is there, then his son, his grandson and great grandson. So 4 generations at a time constitute an HEF. For constituting an HEF, there have to be minimum 2 co-partners. So we often hear 2 words, co-partner and member. So co-partner is a person who is born in the family or is adopted into the family, whereas the person who comes into the family is a mere member. She is not a co-partner. So all the co-partners are member, but all members are not co-partners. So our mother, our wife, daughter-in-laws, all are members, but they are not co-partner. And there are peculiar importance to one being a co-partner and one being a member. For an HEF to come into existence, there have to be minimum 2 co-partners. So for a couple, an HEF will come into existence as soon as a son or a daughter is born in the family. So unless there is a second co-partner in the family, HEF does not come into existence. Since the Hindu law is derived through the judicial pronouncement, and it is broadly not a codified law, there are contradictory decisions are also available. But broadly, what am I discussing is based on my reading of the Hindu law and the reading of the judicial pronouncement at large. So once a family, an HEF has come into an existence, even if there remains a co-partner and a member, the family can continue to remain as an HUF under the tax laws. But the single person with a member cannot start an HUF. So an existing HUF can continue even there remains only one co-partner. But for an HUF to come into existence, there have to be minimum 2 co-partners. However, if there is an ancestral property in the hands of the karta or the male member, then HUF can come into existence on the date of the marriage, because there is already ancestral property in existence at the time of marriage. Let me bring to your attention that the concept of ancestral property is no longer valid after the introduction of Hindu Succession Act 1956. So after 1956, the assets which are inherited by you from your forefathers, whether your parents, father or grandfather, great-grandfather, does not become an ancestral property, and it becomes your individual property. So the concept of ancestral property is given a go by under the Hindu Succession Act. So so for income tax purpose, it will not serve your purpose unless you have an HUF, you have assets under the HUF from which you derive income, and you can file income tax return, or you can invest the capital of the HUF. So there are several ways through an HUF can acquire property. One is through will. So any person can bequeath any property to HUF of any other person, and it is not necessary that the will should be from your relative. Even non-relative can also bequeath the property to your HUF. The second method through which HUF can acquire property, or rather can accumulate property, is through the joint efforts of the members. So if the HUF has business, and where all the members or some of the members work, then with the income accruing to the HUF, the HUF property gets accumulated. One more method through which HUF can accumulate or expand its assets is through transfer or gift of their individual assets by any member of the HUF, including the co-partner. HUF can also accept and receive gifts from outside, whether they are relatives and non-relatives. So for income tax purposes, all the members of the HUF are treated as a relative of the HUF. So your father is not a relative of your HUF, but you are relative of your father's HUF. Likewise, your father-in-law, your son-in-law, the mother-in-law, those are all not treated as relative of the HUF. Why am I getting the sound in the background? So under the Hindu succession, earlier, before the Hindu Succession Act 1956 was introduced, the assets of the HUF used to pass on to the other members by survivorship. So if a member dies, his share would pass on to the other remaining members. So the share of each member used to fluctuate on the birth and death of members in the family. However, after the amendment of Hindu Succession Act in 2005, the death results into passing of his share in the HUF property to his or her legal heir. So as soon for the purpose of determining the share of the person, the deceased person, a partition, complete partition is deemed to have happened, and the share which would have been allocated to the deceased member passes on to his legal heirs, and that asset or the part of the corpus or asset no longer remains property of the HUF. This has made the matter very complicated, and in due course, HUF will not have significant assets, because with the death of members, the respective share will get carved out of HUF corpus. So this is what Section 6 of Hindu Succession Act says, how the assets of the HUF will pass on death of the member co-partner. Let me tell you one thing, that the wife of the Karta, the main HUF, the original or the main person from which the HUF is continuing or starts, on partition of the HUF, he himself, his wife, and his children will get equal share on partition of the HUF. So the assets of the HUF will, in case of a partition, full partition, will be divided first per strip and then per capita. So let me elaborate it. So on partition of an HUF, where there are husband, wife, and 2 married children with their family, so the HUF assets will be transferred divided between these 4 members co-partner equally, 1/4, 1/4, 1/4. And the 1/4 share of each son will be divided per capita. Each member will take equally. So the share of one member may differ than the share of other member in the other family, depending on the number of members in the family. A member, or rather a co-partner, can give away his share in the HUF property under a will, but the co-partner is not allowed to give his share by way of gift. So this also has made matter very complicated, because a non-family member can also be given a share in the HUF property under a will of the co-partner. The Hindu Succession Act Amendment of 2006 has brought in a drastic change as far as rights of daughters are concerned. Earlier, only the sons were considered as a co-partner, but post amendment of Section 6 in 2005, it is named as 2005, but came in effect in 2006. So the daughters are at the same footing as the sons. So they become co-partner at their own, and their rights are equal to the rights of the son. Even after marriage of her daughter, she continues to remain the co-partner of her father's HUF. So can there be multiple HUFs? Yes, there can be multiple HUF. For example, the father will have his HUF, and under that HUF, his wife, his sons and daughters will be member co-partner. Then their sons, if they satisfy the condition of having minimum 2 co-partners, will have their own HUF. So a person can be a member or co-partner of more than one HUF. He can have his own HUF, as well as he can be a co-partner and member of his father's or grandfather's HUF. Likewise, a person can become karta of more than HUF. So on the death of your father's HUF, you can become karta. Normally, the eldest co-partner become karta of the HUF. So suppose your father has passed away and he had an HUF and you also have an HUF. So you can be karta of two HUF at the same time. You will be co-partner of both the HUFs. So one can have more than one HUF at the same time. Likewise, I have explained that one can be a co-partner in more than one HUF. So since HUF is a separate and distinct entity under the income tax laws, enjoying various tax benefits itself. So this concept of multiple HUF can be used for efficient tax planning. So I have explained what are the who is a co-partner and who is a member. So there are difference as far as rights of the co-partners and members are concerned. A co-partner is entitled to ask for a partition of the HUF's assets. So he can ask for his share, but a member, though, is entitled to be maintained out of the core assets and income of the HUF, cannot ask for partition of the HUF. These three things I have already explained, that members who come in family by way of marriage are mere members, and those who come in the family by virtue of birth or adoption are a co-partner. All co-partner are member, but reverse is not true. And sons and daughters now have a equal right. So what the females and HUF law, this I have already elaborated, that daughter becomes a co-partner as soon as she is born in the family. She remains a co-partner even after her marriage. Even she can become karta of the HUF even if she is a eldest child of the family. On the death of the father, normally the eldest male and eldest member becomes a karta. But if the eldest member is not competent to contract or is not willing to become a karta, any other member can be, other co-partner can be designated as karta of the HUF. So the taxation depends on the residential status of the assessee. So there are three categories of residential status. One is resident, the other one is non-resident, and the third category is in between, which is resident but not resident. So if the affairs and management of the HUF is fully outside India, then it becomes a resident, a non-resident. But even if the control or management of the HUF is partly in India, then it becomes a resident for tax purposes. For determining whether the management is in India or outside India, it is not the physical stay of the karta which determines it, but the person who actually manages it. So a karta can appoint any person as a manager, and based on the residential status of the manager, it can be determined whether the HUF is not ordinary or resident, but not ordinary resident. So if a manager is non-resident for 9 out of 10 years, then it will be a not ordinary resident, and it has been in India for 729 days or less during the past 7 years. So in case the Karta is staying outside India, he can appoint somebody else in India to manage the affairs of the HUF in India. Then in that case, the HUF will be treated as a resident of India. So if you are a resident, your global income is taxed in India. If you are a non-resident, then your income which accrues or arises in India, and if you are not ordinary resident, then income which arises through the if income which arises in India or which arises through the source, the income which the source of which is from India is taxed in India. So now we have come to the proper discussion for which you all are interested. So what are the tax benefit of an HUF? Under section 231 of the Income Tax Act, an HUF is a separate tax entity like an individual, an HUF, an LLP, a company, a cooperative society, etc. So an HUF can have its own PAN number, it can file its own ITR separately and distinct from the individual's income, and it can enjoy various tax benefits on its own, which are available to the individual also at the same time. So there are various tax benefits available to an HUF, which we will discuss in due course. The one is the Section 80C benefit, which almost everybody is aware, which allows you one deduction of 1,50,000 from your total income. The basic exemption limit for an HUF is 2.5 lakh, whether it is resident, non-resident, because the varying exemption limits are based on the age of the individual. So for HUF, the same 2.5 lakh limit is provided. Then there are deductions under Section 80T, 80DDB. If in case you have taken a home loan, rather your HUF has taken a home loan, then HUF can claim deduction for interest paid on money borrowed for the purpose of acquiring the house or any commercial property, or even for repair renovation of an existing property. In respect of, since the majority of the members are interested in, or rather engaged in investing and dealing in equity, the benefit of Section 112A is very important for them. So Section 112A provides for a mechanism for taxation of long-term capital gain arising on sale of listed shares on stock exchange or on redemption or sale of equity-oriented scheme. So the Section 112A provides that the long-term capital gains in respect of listed shares and equity-oriented schemes on which STT has been paid will be taxed at a flat rate of 10% without any benefit of indexation. However, it provides for a limit of 1 lakh up to which no tax will be levied. I mean, the tax to be levied will be at 0 rate. So this initial 1 lakh is treated as your income, taxable income, but it is taxed at 0 rate. So effectively, it is made as an exempt income. However, for computing the tax benefit under Section 87, a tax rebate under Section 87A, all the long-term capital gains on listed equity and equity-oriented schemes are to be considered for determining the eligibility to get 87A rebate. Under the old tax regime, if your income does not exceed 5 lakh, then you are entitled for 12,500 tax rebate, and under, if you follow the new tax regime, then the threshold limit is 7 lakh and you get a rebate of 25,000. Please note that the tax rebate of section 87A is available in respect of tax payable on all income except the long-term capital gain payable on listed shares and equity-oriented scheme. So in respect of long-term capital gain on these products, even if your income is below the threshold of 5 lakh or 7 lakh, you have to pay the tax at 10% beyond 1 lakh. Section 54F, there are two major sections which provide for exemption from long-term capital gain if you make investment in a residential house property. Section 54 provides for capital gains, long-term capital gains if you invest in a residential house, whereas section 54F provides that you can claim exemption from long-term capital gain arising on any asset except residential house, for which exemption is provided under 54 if you buy a residential house. But section 54F provides a restriction that this exemption can be claimed only if the assessee does not own more than one residential house on the date of the sale of the asset. So you can claim section 54 if for sale of your land, agricultural land, office premises, shares, debentures, etc. So this, if you have more than one house, or you need to have more than one residential house, then one residential house can be bought in the name of HUF, and you can be out of the clutches of 54 restriction. Section 80C provides for a deduction of 1,50,000. Please note that all these deductions, except this benefit of 112A, are available if you opt for a old tax regime. Under the new tax regime, the deductions under section 80C, 80D, 80TT, 80TD, no deductions are available. So the HUF can claim deduction under section 80C if it pays life insurance premium on life of any member, including Karta of the HUF. Likewise, HUF can contribute to the HUF PPF account of any of its member and claim deduction under section 80C. Please note that the PPF rules do not allow an HUF to have a PPF account, but income tax laws allow an HUF to claim deduction for PPF contribution to PPF account of any of its members. Senior citizen saving scheme is not eligible for HUF because it is allowed to an individual who has crossed 60 years of age. An HUF can claim ATC deduction by making a fixed deposit, which is called a tax saving deposit. An HUF can invest in equity linked saving scheme also to claim the deduction under section 80C. And since the ELSS has a lock-in period of 3 years, the profits automatically become long-term and can avail the concessional or rather zero rate of tax on the initial 1 lakh. If an HUF is able to get a home loan, then the section 80C provides for a deduction of repayment of principal amount of home loan taken for buying or constructing a residential house. Even stamp duty, registration charges, and transfer fees paid to get the residential house registered in your name is also eligible for deduction under section 80C in respect of residential house. The deduction is available only if the loan is taken from specified institutions like banks, housing finance companies, central government, state government, public listed public company, which is your employer, etc. Please note that if the house property which is bought with the help of home loan and on which deduction has been claimed under section 80C, and if the property is transferred within 5 years, so not only sold, even if you transfer the property within 5 years from the end of the year in which the possession of the house is taken, then the deduction which you have claimed under section 80C gets reversed, and the deduction claim earlier becomes income of the year in which the house is sold. The deductions is available only when you get possession of the house. So as long as the house is under construction, you cannot claim this deduction. The possession need not necessarily be an actual possession. It can be a constructive possession if the keys are handed over. So you can take the constructive possession without having visited the place. So if you just get the keys, you get the possession. The other benefit which is available in respect of residential house for HUF is in respect of interest paid for purchase, repair, renovation, etc. for any property, whether it is residential or commercial. This deduction is available up to 2 lakh for maximum of 2 self-occupied property taken together. And if the property is let out, you can claim full interest deduction. But in respect of loss under the house property income, you are allowed to set up only up to 2 lakh against your other income, like your business income or your salary income. And the loss which cannot be set up against other income is allowed to be carried forward for 8 years, and which can be set up against your house property income. So if this is for old tax regime. If you follow the new tax regime, you do not get any benefit for self-occupied property. However, if the property is let out, you can claim interest up to the taxable amount of rent, and any loss which results after computation of the taxable income under house property is not allowed to be set up against other income. A member of an HUF can pay rent to the HUF because both are separate tax entity, and the member can claim HRA in respect of the rent paid. The tax laws allow you only 2 house property to be treated as a self-occupied property. And in case you have more than 2 self-occupied property, then you have to opt which 2 properties you wish to treat as a self-occupied, and the other properties are the other self-occupied property beyond 2 properties are treated as if they have been let out, and a notional rental income. Notional rental income is not nominal. It is a market rent which you have to offer for tax, even if you have not received any actual rent. If the house is sold in a short time before 5 years or any time after taking possession, there are no income tax provision for reversal of the tax benefit which you had claimed earlier, unlike deduction in respect of repayment of the home loan. Section 80D allows you a deduction of 25,000 rupees for buying health insurance policy, and if the premium is paid for a senior citizen, the deduction goes up to 50,000. So an individual can claim 25,000 for his family and 25,000 for his parents. In case the parents are senior citizen, then he can claim 25 plus 75. If you are a senior citizen and your parents are also senior citizen, then you can claim 50,000 plus 50,000, 1 lakh deduction. So this is as far as an individual is concerned. In case the premium, since the premium of health insurance gone up significantly, and the amount of deduction available does not meet that amount, you can claim part of the policy payment made from HUF and claim the deduction while filing the ITR of HUF. In respect of health checkup, you are allowed a deduction of 5,000 in each category, which can be paid in cash. However, for claiming other deductions of medical insurance, the payment has to be made otherwise than by cash. So you can make NEFT or you can pay check and pay credit card, etc. So as long as it is not paid by cash, you can claim it. In case of senior citizen who does not have a health insurance policy, you can claim a deduction of up to 50,000 in respect of each senior citizen in his return, etc. Or 50,000 for your parents in your return for day-to-day medical expenses as well as for hospitalization. So this benefit can also be claimed in HUF. There is a section, I do not see why this heading is not visible to me. So this is deduction under section 80DD, which allows deduction for medical treatment, training and rehabilitation of dependent special person who is suffering from some disability. Even if you pay some money into an insurance company for maintenance of the dependent children, you get a deduction of 75,000. And in case the person is suffering from severe disability, a higher deduction of 1,25,000 is available. Then we come to section 80DDB, which is available only to a resident. So deduction is available for medical treatment of specified disease. The deduction generally available is 40,000, and if it is for a senior citizen, then it is 1 lakh. So the deduction is available up to 40,000 or 1 lakh, or actual expenditure incurred, whichever is lower. So maximum deduction available is 40,000 for a non-senior citizen and 1 lakh for senior citizen. This section 54 allows, so section 54 benefit, I have touched upon it earlier, allows you an exemption from long-term capital gain if you sell a residential house property after 2 years. After 2 years, it becomes a long-term capital asset, and the capital gains are treated as a long-term capital gain. So if you invest the indexed capital gain for buying another residential house within a specified period, so that if you buy it ready to move in house, the same has to be bought within 2 years. Even if you have bought a house within 1 year prior to sale of the residential house, you can claim. If you go for self-construction or book an under construction property, higher period of 3 years is available. The house has to be purchased in India only, and for sale of one residential house, you can claim only if one residential house is bought. However, a once in a lifetime opportunity is provided under the Income Tax Act to invest the capital gains on sale of one residential house and 2 residential house, and claim exemption under section 54 if the capital gain do not exceed rupees 2 lakh. Law provides for a longer duration during which the amount is to be utilized for buying or constructing the property. But the amount which you are not able to utilize for the purpose of buying or constructing the house, by the due date of filing of your income tax return, the unutilized portion has to be deposited in a capital gains account with a bank, and which can be utilized for this purpose within the time allowed, within 3 years. So if you do not utilize, or you are not able to utilize the money in capital gains account within 3 years, then the money becomes taxable in the year in which you withdraw the money. This is deduction under section 54B in respect of agricultural land. So agricultural land proper, as per income tax, if it is within beyond that municipal limit, etc., is not treated as a capital asset, and there is no capital gain on sale of such agricultural land proper. But if agricultural land which does not satisfy the definition of agricultural land, so you can claim exemption under section 54B for sale of the agricultural land which was used by the HUF for agriculture, and the capital gains are invested for buying another agricultural land within 2 years, like for residential house, and used for buying agricultural land. Then there is section 54F. So there are basically 2 sections which allow you exemption for making investment in house to save long-term capital gains. Like section 54 is applicable when you sell a residential house. And if you sell any other asset other than residential house, then 54F is applicable. 54 requires you to invest only the index capital gain, but 54F requires you to invest the net consideration received. Suppose if you have sold the residential house, then you can claim exemption under section 54 and have to invest only the index capital gain. But if you have sold a commercial property, then you have to invest the full sale consideration in a residential house. As I've explained earlier, section 54 requires that the assessee should not own any house, not more than one house property on sale of the asset. There is exemption under section 54 EC. So if you do not want to block your capital for buying a residential house, then you can invest your capital gain, whether it arises from residential house or from non-residential, any asset other than the residential house. You have to invest only the indexed capital gain within the 6 months from the date of the sale of the asset. The bonds have a tenure of 5 years and carry interest of 5.25%. You are allowed to make investment of up to 50 lakhs in a year and in respect of a year. So if the period of 6 months spills over the next year, then also you can investment in both the years cannot exceed 50 lakhs in respect of capital gain exemption for that year. Lots of people are curious to know whether an HUF can carry on business. So there are no restrictions on an HUF carrying on business. And in fact, many people are carrying on business in their HUF name. HUF can pay salary to its karta or its member, and which has been appealed by a Supreme Court in the Jugal Kishore case. However, the income tax officer has a right to examine the reasonability of the remuneration paid. So the remuneration paid should be bona fide for commercial purpose and should be reasonable vis-a-vis the services rendered by the karta or the member. in respect to remuneration paid to non-professionally qualified people from the firms in which a person is interested, clubbing provisions apply. But in respect of rent paid or salary paid by HUF to its member, clubbing provisions are not applicable, and the salary or rent, etc., paid by HUF is taxed in the hands of the person who owns the property or who is in receipt of the salary. As far as the commission income in HUF is concerned, if the HUF has a regular activity of carrying on commission business, then commission income can be had in the HUF. But isolated receipt of commission is not allowed. Then it is treated as a income of the karta, because the income must have arisen to the due to the efforts of the karta, and the income tax officer may tax it in the hands of the karta. So HUF cannot become partner in a partnership firm as per the RBI guidelines. However, and a karta can become a partner in HUF, represent partner in a partnership firm representing his HUF, and any remuneration which is received by the karta will be taxed in the hands of the karta, and not in the hands of the HUF. However, and any interest paid to the HUF will become taxable in the hands of the HUF, because the money belongs to the HUF. Whether an HUF can receive gifts, so there are no restrictions as far as the receipt of gifts by HUF are concerned, but there are tax implications. So any person who receives gift in excess of 50,000 rupees in a year, the threshold of 50,000 is taking into account all the gifts received during the year. So once the threshold of 50,000 is crossed, the entire value of the gift becomes taxable. However, there are some exceptions, like when the gift is received from a relative. So for the purpose of income tax, the members of HUF are treated as its relative. So when HUF gets gift from its member, it is not taxable in the hands of the HUF. However, it becomes the income any which arise due to the asset given by the member to the HUF, it gets clubbed with the income in the hands of the person of the member who has transferred to the asset to the HUF. However, if the gifts are received from non-relatives, like your parents-in-law or brother-in-law, sister-in-law, etc., then and the amount exceeds 50,000 rupees, then the whole of the gift becomes taxable in the hands of the HUF. HUF can borrow money, and it is the karta who is authorized to borrow money on behalf of HUF. HUF can lend the money also to its members, to outsiders. As far as giving of loan to its member is concerned, if it is given interest free by the HUF, and when the HUF is paying interest, then HUF cannot claim deduction in respect of interest paid, because you cannot give interest free by borrowing money, by borrowing interest bearing money and claim that interest. This is just transfer of income, which is not allowed. Well, in case of all such transfer, where only income is transferred and asset is not transferred. Suppose a member or anybody transfers the rental income to someone's HUF, but the asset is not transferred. Since the asset is not transferred, the income will continue to be taxed in the hands of the original owner and not to the person who is receiving the income, whether it is HUF or anybody else. In respect of irrevocable transfer, revocable transfer, when you make a transfer subject to the transferor retaining the right to revoke the transfer, then the income becomes taxable in the hands of the person who transfers the asset. However, if the transfer cannot be revoked, cannot be cancelled during the lifetime of the beneficiary, then the clubbing provision will not apply. As we have discussed, when the member of HUF transfers any asset in the name of HUF, there are no tax implications whatsoever is the quantum of the asset transferred to the HUF. However, any income which arises to the HUF from the gift so made will become taxable in the hands of the person who has transferred those assets. Even when the partition takes place, and though the clubbing provision will cease to apply, but they will continue to apply in respect of the share of asset which is received by spouse of the person who had transferred this asset. So this is a hot subject, common civil code. So what will happen if and when the common civil code is implemented? So as and when the common civil code is implemented, either the common civil code will have some provision about existing HUF, or Income Tax Act will have to provide. Let me tell the audience that the HUF concept of HUF or HUF as an entity is not recognized in the state of Kerala. So the legislation which banned the HUF as an entity had provided that the assets owned by HUF after enactment of that law, the asset will be held as a joint owner by the earlier co-partner. So then the respective income will become taxable based on their share in the property. Under the Hindu law, or for practical purposes, the assets of the HUF can be distributed wholly with all the assets and vis-a-vis all the members, or it can be partially distributed. Only a particular asset can be distributed, and balance asset continue to remain that with the HUF. So this is when all the assets are not distributed, it is called partial partition, and when all the assets are distributed among the members, it is called full partition. The income tax law does not recognize partial partition, and in case any partial partition happens, the income from the assets so partially partitioned will continue to remain taxable in the hands of the HUF. So for affecting full partition, you have to make a partition deed, full partition deed, and get the fact of full partition having been taken place from. You have to make an application to the assessing officer, giving you an order recording that the full partition has been taken place. This is a requirement under the income tax law. As far as distribution of income of HUF is concerned, distribution of current income of the year can be distributed and is tax-free in the hands of the members. However, if you distribute any past income, then it will be treated as a partial partition, and the consequences will follow. So what should you do for having an HUF? So as I explained that HUF can become an extra tax entity which entitles you for various tax benefit as explained. So what you have to do for accumulating the HUF assets, you have to take gifts from non-relatives. If you take gift from relative, then the clubbing provisions apply. If you take gift from non-relative, include that gift in your income, claim the deductions, etc., and plan your taxable income in such a way that after the eligible investment, etc., there is a minimum tax liability. HUF can own a property, can claim deduction, etc. This is the most important part. What you have to do to create an HUF. So for getting an HUF as a tax entity, first of all, you have to obtain a PAN number in the name of HUF. Then after you have obtained the PAN number, you open the bank account in the name of HUF. If you are investing in shares, go for regular KYC, open Demat account, etc. I would advise all the audience to preserve all the documents and books of accounts, etc. The Karta is authorized to manage the assets of the HUF. So Karta has to sign all the documents, etc. Please note that since the HUF does not come into existence by act of parties, no agreement is required to be made. However, the income tax department insists for an affidavit to be attached with the application form for making an application for permanent account number. While making this affidavit, which has to be notarized, you have to mention the date of incorporation. So the date of incorporation is the date on which your first children is born. Please mind it. So we come to the final leg of the questions. So whether a mother-in-law with a daughter-in-law can constitute an HUF? Simply no, because none of them are co-partner. Whether father and daughter can constitute, since father is a co-partner, daughter is a co-partner, they can constitute an HUF. Whether two sisters can constitute an HUF? Yes, two sisters. If the two sisters will constitute an HUF of their father, they on their own cannot have an HUF, since the HUF is a group of people who have descended from a common male ancestor. Can a person be member of more than one HUF? This I have already explained. At least one person can. It is not necessary that an HUF should have ancestral property for it to come into existence. It can come into existence, and it comes into existence automatically when a child is born. But even for HUF assets to be created or to be accumulated, it is not necessary that you have a ancestral property as a starting point. Even HUF assets can come into existence through assets received as a bequeath under a will or gift from relative, non-relative friends, etc. Whether a non-co-partner member throw assets in the HUF, yes. Whether you are a co-partner or you are a member plain, you can gift your own assets, self-acquired assets or inherited assets to the HUF. Can daughter demand partition of father's HUF as she is a co-partner? She can ask for partition, but after her marriage, she becomes a member in the HUF of her father. But since she is a member plane and not a co-partner, she cannot ask for partition of the HUF of her husband. But as and when the HUF is partitioned, she will get an equal share equal to her husband. Can a wife bequeath her share in HUF? Wife is not a co-partner. She is a member. Though she is entitled to get a share as and when the partition takes place, but she is not a co-partner, so she cannot bequeath her share of corpus in the HUF. Does a partition takes place at the time of death of a co-partner? The death of a co-partner does not automatically result into full partition of the HUF, but a dim partition is presumed to have taken place on the date of his death to determine who inherits his assets on his death, his share of assets in the HUF asset on his death. As far as partition of HUF assets among its members is concerned, the partition can be equal or unequal. If all the members agree, even a one person can get all the assets of the HUF to the exclusion of all the members. Miya Bibi Raji to kya karega Kaji? So as long as everybody agrees, outsider cannot have objection. The assets which you receive on partition of the HUF is not an ancestral asset. So as I've explained, the concept of ancestral asset is done away with after 1956. The asset which you receive on partition of your HUF is your personal asset. It is, and so this cannot form capital of your own HUF. The asset which you receive on full partition of your father's HUF or your grandfather's HUF or great-grandfather's HUF will be your individual property and not the property of your HUF. So this brings us to the end of the discussion.
Sir, there are certain questions, sir.
Yes, please shoot the questions.
Sir, the first question is HUF useful for salaried individual with no business income?
So that depends. How do you accumulate the capital in the HUF? So if you are able to get gifts, etc., in the HUF and make investment in the name of HUF, so then even if you are a salaried, part of the income can become taxable in the hands of the HUF.
Okay. Next question is, can stocks purchased be transferred to HUF directly, or should I have to sell and rebuy an HUF portfolio?
Can you repeat the question?
Can stocks purchased be transferred to HUF, or I have to sell and rebuy in HUF portfolio?
No, you can transfer the shares purchased by you to HUF. So let me add, if you want to transfer those shares to your own HUF, though the value will not become taxable in the hands of HUF and is no tax implication for you, but any income, including dividend income and capital gains, which arises in the accounts of the HUF, will continue to be taxable in your hands. The clubbing provisions will apply.
Okay. So can HUF be formed if the son or daughter is minor?
Yes, as I explained, the HUF is not formed. It comes into existence. So HUF and HUF property are two different things. There can be an HUF without there being any HUF property. So as soon as your son or daughter is born, your HUF comes into existence. So it may not have any asset, HUF asset as on that date.
Can a single daughter become karta after father?
So as long as there are two co-partners, the HUF can continue. But if after death of father, if there are the mother and the daughter, So since the mother has a right to be maintained out of the corpus of the HUF, the sole co-partner can continue the HUF of her father.
These rules apply in case of inter-religious marriage.
No. As soon as a person marries outside the Hindu religion, he is no longer Hindu and he does not remain part of the HUF.
Okay. Next is, can we start a medical shop under HUF?
Obviously, why not?
Okay. Can we distribute amount from HUF?
So as I explained, you can distribute the current year's income, which will be tax-free in the hands of the members. But if you distribute the past income or past assets of the HUF, it will be treated as a partial partition for income tax purposes, and which is not recognized under the income tax law. So though there is no restriction on you transferring assets or distributing assets, the income which arises on the assets which are transferred will continue to be taxed in the hands of the HUF.
Next question is, if the son starts HUF, can we include father and mother in it?
No. So your father and mother are not part of your HUF. You are part of your father's HUF. So your father, since your father already has his HUF, and you are co-partner of your father's HUF. But your father, in your HUF, your father is not even relative and not a co-partner or member, because the law of co-partnery flows down from a common ancestor downwards.
Okay. The last question is my question, sir. In case of any legal issues like divorce, can a husband claim the wife's property of HUF?
No. See, wife is not entitled to ask for partition. So if the divorce takes place before the HUF is partitioned, then the wife share gets diluted, gets erased from the HUF. So the question of husband claiming wife share does not arise. As I explained, it is only the wife of the main person, main ancestor, who is entitled to get a share on partition, and not all the daughter-in-laws in the family. So the assets get distributed per strip first, and then when the particular family gets their share, it is distributed among all the members equally.
Can we distribute last year income this year?
No, it will be treated as partial partition, and clubbing provisions will follow.
Okay, sir. Next question is, can son continue to be co-partner after his own HUF is formed?
Yes, as I explained earlier, a person can be a co-partner, member and karta of 4 HUF at a time. His own HUF, his father's HUF, his grandfather's HUF, and great-grandfather's HUF.
Anybody wants to say, can ask question, can mute themselves and ask. Okay, sir. Last question is, how much is the cost to form HUF account?
Pardon?
How much is the cost
For
to
what?
form a HUF account?
There is no cost involved except the professional fees which you have to pay to the chartered accountant for filing your 49A and for getting the affidavit made. So I don't think it would cost you more than 4,000, 5,000, including everything.
Okay. And the last question somebody has typed is HUF starting age.
What is the question?
HUF starting age. They have
Start-
mentioned.
No, HUF starts when a child is born in the family.
Okay. That's all, sir. That's all the questions, sir. Thank you, sir, for the wonderful session and clearing a lot of concepts. I hope that many people will now start a HUF account and divide their tax between the two accounts.
Pardon?
And now, sir, there's one more question. Can we distribute to minor?
Yes, the minor is also entitled to get share when the HUF assets are partitioned. Though HUF cannot contract, so the guardian will manage the minor's assets, but minor will also get a share in the HUF corpus, HUF assets as and when the HUF is partitioned.
Okay, sir. Thank you, sir. You can stop sharing, sir.
Okay, thank you.
Okay, and for the remaining people, there was a discussion in the group regarding the gold. So I would just like to share one thing regarding this gold. I can see that all of you have seen this rally. Okay, if you can see in the last 1 month, you can see there was a significant rally of around 10%. And if you see why I'm bringing in this topic is, if you see the gold rally in the last 29 years, it was initial, if you take the price before 29 years, it was 4,680. This is for 24 karat gold. Now it is around 75,000 and the duration is 29. And if we calculate the CAGR returns, it is 10% for the last 29 years. And if we take the Nifty, same period, it was 1,000 and now it is around 22,519. In the last 29 years, it is around 11%. So it is almost catching up with Nifty for the last 29 years. Okay. And where is the future prediction of gold? So if you see, if I invest today's price of 75,000 and same 10% which I showed you the CAGR, and in the next 4 years, you can see touching 1 lakh per gram of per 10 grams of 24 karat gold. So 1 lakh is possible. So please diversify for gold and with this all the geopolitical tension, because gold and it is catching up with Nifty almost 10% and 11%. It is very near. So don't just invest everything in equity. Thank you. So I'll end this session, sir. Thank you, Balwant Singh, sir. If any doubts are there, please post it in the WhatsApp group so that you can have, if you have any doubts about HUF's accounts, sir will try to solve the questions. Thank you. We'll meet for the next session in our coming alternate Sunday. Thank you.
Thank you, Harish sir, and thank you, Balwant sir. Thank you, team IAPTCB and PATS. Thank you so much.